Now we're good to go. Now we get things started. Okay. Hello and welcome to the Lake Stevens Chamber of Commerce October Chamber Luncheon featuring Doug Warren of Larsen Financial Services. Before we get to Doug and his valuable information about personal finances during these strange and turbulent times, a few announcements. First, we need to thank our gold investors for 2020 Ace Hardware of Lake Stevens, as well as Community Transit. Thank them for being gold investors in the Lake Stevens Chamber of Commerce, as well as our silver investors, Waste Management, Heritage Bank, Wells Fargo, and Republic Services. Thank them for being on board too. I want to let you guys know about a special lunchtime presentation we've added in a couple of weeks. Chat with the Chiefs will be on October 28th via Zoom. We will be joined by both Chief Dyer and Chief O'Brien, and we'll be getting an update on police and fire services here in Lake Stevens. Registration will be through Zoom, and the link is available on our website at www.lakestevenschamber.com. This will be on a Wednesday, October 28th, and again beginning at noon. For our November Chamber Luncheon, we'll be having another in our series, Connect with Brett. City of Lake Stevens Mayor Brett Gailey will join us for a town hall style meeting, updates, talk to us about goings on in and around the city of Lake Stevens, and take questions from the audience. We'll also be going over the results of the Board of Directors elections, which I'll talk about in just a moment. A quick note about the November Chamber Luncheon. We have moved the date so as not to conflict with the Veterans Day holiday. The November Chamber Luncheon will take place on Wednesday, November 18th, starting at 12 noon. This is 1 week later than our normal second Wednesday of the month, so please make a note of that. Registration will be again through Zoom and is open through the events calendar on the website. I mentioned the Board of Directors elections. We're running things a little bit differently this year due to the COVID pandemic and the restrictions on personal meetings. We'll be doing voting for the Board of Directors elections online through our website. Each business membership will be allowed one vote, and it will be cast by the primary member of each business member's account. We will send an email to all primary members to let them know that the polls are open and that they can log into the system and cast their vote. The primary member for each business member must be logged in to vote. If you're unsure who your primary member is for your business or organization, or if you're having trouble logging in, please reach out to the Chamber office at 425-334-0433 or email us at info@lakestevenschamber.com. Emails to primary members will be going out by the end of the week, and as mentioned, we'll announce winners at the November Chamber Luncheon on November 18th. We're going to be electing 4 board members to 2-year terms this year, the terms that will begin in 2021. We're finalizing the list of candidates at this time, and we'll publicize the list in the newsletter on Thursday. I know Juanita's on it, and who else is on there? Lily and Frank are on there. Cindy Ann as well are all on the ballot, as well as a couple other people. So we'll publish that list of people in the newsletter on Thursday. So keep an eye out for that. I also want to remind you about our upcoming networking events. 1 week from today will be our October Networking After Hours, and this month we'll be holding it on the Blitzer platform. Blitzer's a new platform that attempts to bring back something that we lost when we were shut down amidst the COVID pandemic, the one-to-one networking that we used to get when in person. Blitzer brings this back with one-on-one timed sessions. Once you register, you can see all the attendees for the meeting and prioritize each person with a green, yellow, or red light system. Once the meeting starts and after a brief welcome presentation, the system pairs you with another attendee for a 5-minute one-on-one conversation. Once that time is up, you get paired with another attendee until we reach the scheduled number of meetings for the event. There'll be a brief exit presentation, and then the meeting ends. But Blitzer is really great because from there, Blitzer keeps track of all the connections you made during that meeting. You can go back and review them, send them messages, as well as request a meeting directly with them. And there's even a place to take notes on the meeting you had with them, so you can keep track of what they do, who they are, stuff like that. So it's a neat little platform, and it really does a great job of bringing the one-to-one networking back into our networking events. So we're hoping you can join us for Networking After Hours on this new and exciting platform on October 21st, beginning at 5 p.m. And don't forget about our morning mingle on October 27th. This will be held via Zoom and is a casual small group meeting that we would like to invite all of you to join us for. It runs from 8 a.m. to 9 a.m. on Tuesday, October 27th. And we'd like to invite you to come when you can and leave when you need to. So registration for links for both networking events, networking after hours, and morning mingle are available on the Chamber website and on the events page, as well as at the very bottom of the front page, of the home page. There's little blurbs about each one of those, as well as the upcoming luncheon for next month. Or actually, we'll put the chat with the Chiefs information down there here after this afternoon. Let's get on to why you all came. You didn't come to listen to me babble. You came to listen to Doug babble. So, Doug Warren. Quick introduction here. Doug Warren joined Larsen Financial Services New York Life in 2004 and has 20 years in the insurance and financial services profession. Since being a financial services professional with New York Life, he is qualified for New York Life's council each year. Doug is a qualifying member of the $1 Million Roundtable. He does free-based financial planning and investment advisory services as a financial advisor through Eagle Strategies LLC, a registered investment advisor. Doug currently serves as the president for the Lake Stevens Community Food Bank, and he is a former president of the Snohomish County chapter of NAIFA and the Greater Lake Stevens Chamber of Commerce. He's a proud member of the Lake Stevens Lions Club as well. Doug and his wife Nico are lifelong residents of the Snohomish area. Their son Nate recently came back to Lake Stevens after serving in the U.S. Navy as a corpsman. Their daughter Haley and son-in-law Corey live in Edmonds and are both in the engineering field. Doug has more time to devote to his community now, and that his kids are grown. He has more time for his outdoor passions of fishing, hunting, jeeping, hiking, and camping, and keeping up his fabulous yards. We've seen some pictures of those, Doug. They're great to see. Let's give a warm welcome to Doug Warren. Welcome, Doug.
All right, thank you. Good to see everybody today. So I'm going to kind of jump right into this and share my screen with you all so that you can see presentation that we're going to do here. So Matt asked that I talk about, financial concerns during the time of COVID, and also obviously it's a pretty volatile market that we're seeing right now, and just how we should be reacting to that. So the first thing I wanted to do, this is what's called an Ibbotson chart. And I grew up, my dad was an accountant and financial planner in Snohomish. And I remember this chart being up in his office from the time I was a kid. So obviously it didn't have the last 40 years on it, 30, 40 years on it at that point. But really, I think the story is the same, whether it had those 30, 40 years on it or not. What we're looking at here is from the beginning of the stock market to today, the growth of a dollar. And it's that dollar as it relates to where it was. So you'll see here, if you follow my cursor, inflation is this gray section. And that dollar today, at the end of, this was through 2019, would be worth $14. So in other words, it takes $14 to equal what a dollar did back in 1926. So then the next line here, this green line, it would be if you invested in treasury bills. So if you put $1 in treasury bills back in 1926, it'd be worth $22. Government bonds, if you'd put $1 in those in 1926, be worth $159. Large stocks, so these are going to be like your Boeings and AT&Ts and Microsofts and things like that. And obviously some of those weren't around in 1926, but $1 in large U.S. stocks would be worth $9,244. And if you put it in small stocks, it'd be worth $39,000. So it's kind of a risk versus reward. But I think that the story here is really that when we're talking about the growth of the economy, the market's always gone up. There's been those times. I mean, these are the most recent times that we lived through. That was the Great Recession. But when you stretch it out onto the big picture, it really is just kind of a blip in the map. And even when we think about the great time where it seemed like these last 4 years, which is really only representative of the last 3 years, they're just a really tiny blip on the map in the market in comparison. So just to kind of further emphasize that this is what's called, what do they call this? Turbulence with confidence. So how to navigate through the turbulence with some confidence. So here's 5 periods of time. The Great Depression, where we saw 4 years of down market, but then the next year, 1933, we saw a market that did 54%. World War II, there were 3 years, basically more like 2 years of down market, and then a year that did 20%. The oil crisis. So I was just a kid at this time, but I do remember the gas stations lined up on Avenue D in Snohomish. Juanita, remember Kirsten's gas station that had the line, a mile long for people trying to get gas. The tech bubble. This was when we all were told that the world was going to end, right? Like unplug your computers, December 31st, 1999, because the world's going to come to an end. Well, it didn't, but we definitely saw that tech bubble crash. And this is actually right when I got back into the financial services industry, because I was in the tech industry. And this, along with, if we remember, September 11th, this added to this. So we were already in the tech bubble had crashed, and then what it doesn't say there, that September 11th sure didn't help that. But we came out of it on fire, and from 2003 through 2007, the market was doing well. Everything was doing well. The economy was doing well. The stock market was doing well. The housing market was doing well. And then, of course, 2008 hit. And just a quick little story. I've been the president of the chamber twice. The first time was in 2008. And as you can see, the market was down 37%. We had we just called it our annual auction back then. And in 2007, that auction we did about $35,000. It was the earnings at the auction. In 2008, when I was the president, the place was like, you could hear crickets, and we did $3,500. So, we've lived through these times, right? But then 2009, we came out, and this was actually March of 2009 was when the market turned around. So it was really from March 9th through the end of the year that we saw the increase, the 26%. And then the market's been on fire since then. So this is just really telling us that, yes, we see times when the market has volatility and has down times, but it always comes out of it. We haven't necessarily seen that yet. We did back in this March where the market took a hit, but it came right back. And we need to not be fearful of that. So that's probably gonna be my biggest message of today is don't be fearful of volatility in the market. As a matter of fact, it often represents a buying opportunity, a time that you can really make hay there. So that kind of goes into this part about emotions. And I couldn't find a PDF of this, so I had to actually just take it off my off the flip thing I have on my desk. So anybody who's been in my office has seen this, because I keep it on this page on my desk, and everybody looks at it and they all kind of go, okay, I get it. So it's, you're starting out and you have optimism, and you about your investments, about retirement planning, about the future of money. And as it goes up, you've got excitement, and then there's thrill, and you see this little guy here saying, wow, am I smart? And then all of a sudden you get to this point of maximum financial risk. That's where your money's really done something, and now you're sitting on some money. But this is the point where, if we all knew where this point was, we'd all sell the cash, right? I mean, we'd be like, okay, here we go. Now it's time to sell the cash. Because then what happens is you still think that it's going up. And then all of a sudden, oh, there's a little bit of anxiety. And then you can just see all these different, and this right about in here is when people start calling me saying, I want out. And it's like, well, wait a minute, you should have got out up there. If we were going to start trying to time the market, you did it wrong. You missed it. And, now this guy's saying, how could I have been so wrong? And so, but then again, then here you are, just what I was saying on that previous slide, the point of maximum financial opportunity. If I just go back to this previous slide, if we think about these times when the market was down, like 2008, when it was down 37%, this would have been the time to jump in, right? If you really knew what you were doing. But nobody does. The talking heads on TV all say that they do, but they're wrong as often as they're right. So then, you get, you just go right back through the cycle. I mean, it just turns around where all of a sudden, boom, you hit optimism again, and you're right back to the beginning of this. And it's a roller coaster of emotions. You got to really try and take the emotion out of planning and investing. And so when we're in times like this, we got to take the emotion out of it. A lot of people have a lot of emotion tied up in it right now, especially because we kind of have two things going on. I'm going to say there's three things going on. We've been in a bubble in the market. The market's been has really done nothing but go up since 2009. That's a little bit of blips, but really nothing. And that can't last forever, right? That's what everybody says. This just can't last forever. And then we've got COVID, and then we've got an election coming up. And so you kind of take all those things, and I think everybody's emotions are really heavy right now. And so we're going to address that a little bit more here. So let's take, this was $10,000 invested. So I love the title of this, Time in the Market versus Timing the Market. So that was the thing we were just talking about earlier, right? That if everybody knew what they were doing and had a crystal ball, that you would have jumped out at certain times and jumped back in at certain times. So here's the story of three investors that tried to do that. So the three different types of investors. So this would have been from December 31st of 07. So right before the Great Recession, and just the beginning of it. They all invested $10,000 into, and this is the S&P 500. So investor A, what did investor A do? They remained committed to a long-term investment strategy and just stayed the course. So yes, their 10,000 dropped down to 5,000, basically 5,400. I guess it says it right here. Market bottom 51.55. So by February of 2009, their 10,000 had gone down to 51.55. But they stayed the course. They said, "Hey, I've got time before I need this money. I'm just going to stay the course." And here at the end of 2019, their 10,000 was now worth 28,417. Okay, so investor B decided to briefly exit the market. So they said, "You know what? I'm gonna get out of the market." And I don't know if it says on here, but there's exited the stock market for 1 year, then reinvested. So at the bottom of the market, and trust me, I've had people do this. We've talked most of them out of it, but we have had people do this. That in March of 09, they called up and said, "I can't take this anymore. I got to get out." We're like, no, it's too late. What we need to do is stay the course. But this guy said, "No, I'm going to get out." Well, then all of a sudden he saw the market starting to go up. He saw his buddy, the guy, he's at Boeing and he's standing around the water cooler, and the guy next to him says, "Hey, yeah, my stuff's coming back." And he goes, "Oh, okay, I better jump back in now." So he jumps back in. He wasn't too late. His 10,000 is now worth 18,498. Not too bad. I mean, he's still pretty happy. And you can see that his basically just mirrored what his buddies did. He just missed out on that year of earnings. Investor C said, he got to this point where the market, where he was down to 5,155, called up and said, "I just want to go in cash. Matter of fact, I'm going to give me my money. I'm going to go put it in a coffee can in my backyard. I can do better with it in a coffee can in the backyard." And trust me, I have heard that a ton of times. Funny story, I heard about a guy whose life savings was buried in, I don't know if it was coffee cans, I think it was like in boxes or bags or something in the backyard. And when he went and dug it up, however many years later, worms had gotten into it and eaten all the money. Like it was composted basically. But this guy, he put it in his safe at home or whatever, and well, actually invested in cash, so it was earning in the bank, which we all know what, how much you can earn in the bank. It used to be that you could make a little bit, but the banks aren't paying anything because rates are so low right now. Well, now his 5,000 is worth 54.34, and he's like, hey, at least I didn't lose any more money. Did you though? I mean, you actually lost because inflation was a lot more than that $434 over that 12-year period. So you really did lose money. And so if these three guys were going out to coffee, investor C is probably not paying, and he also is probably a little embarrassed at what he did. So it's really about the time that you spend in the market. But we also have to think about, let's talk a little bit about, they call this taking turns at the top, but I like to call it like Baskin Robbins. And I'll tell you why here. Each of these colors, I have to realize that you can't see me pointing at my screen, so I need to use the pointer here. So each of these colors represents, and hopefully you can read it depending on how big of a screen you're on, a different asset class. So just here in 2005, the top asset class for 05 and 6 was foreign stocks. So let's say that in 05 you decided to get in the market, and you look and go, oh, foreign stocks, wow, they really kind of did so well, and look how poorly bonds did. They're clear down here at the bottom, only did 2%. Foreign stocks did 13.5%. I want in there. Well, the next year you were right. Foreign stocks went up 26%. The bonds were only up 4%. You're like, see, I knew what I was doing. I'm doing a pretty good job. The next year, foreign stocks were in 3rd place. Bonds had actually come up and were in 5th place, but you're still feeling pretty good about that, right? Then in 2008, foreign stocks went down 43%, so basically lost everything that they had earned those 3 years previous, and bonds were the only thing that was positive. So you're going, well, now what do I do here? Because then the next year you can see bonds were all the way at the bottom again. So if you had jumped out and said, you know what, I'm going on all those foreign stocks, I'm going to get into bonds now. Well, now all of a sudden bonds are all the way at the bottom, and foreign stocks were in the middle. So the reason I call this the Baskin Robbins is it's kind of like 31 flavors, and you really want a little scoop of each. You want to have a little scoop of this, a little scoop of that, and it's called diversification between different asset classes. And what proves that here is this lavender color right here is blended returns. So that's a blend of all of these. And you see that it always kind of rides right in the middle. And so a lot of times investors will say, well, how come the market did, 15%? S&P 500 did 15%, but my account only did 7%. Well, do you have the fortitude to jump 100% into the S&P 500 when you're 10 years away from retirement, let's say? Or do you want to have a good diversified portfolio that isn't going to just ride what the S&P 500 is doing? I mean, if you're 20 years old, go ahead, jump all in S&P 500 and don't look at it for years. But that doesn't make a lot of sense for someone who is really doing some retirement planning. So next, let's talk about taxes, because that's the next effect on this story, right? Is how much of the money do I actually get to use? So there's the one part is how much of the money do I have, but then it's how much of it do I actually get to use? And in retirement, this can really affect us. Every time that somebody calls me up and says, I want to take 10 grand out of my retirement account, one of the first questions, or one of the questions that I have to ask is, do you want to have taxes taken out? And if so, how much? Right now, it may be hard to believe, but we're in some of the lowest tax rates that we've seen in our lifetime. If we look back here in the 70s, you can see the highest tax rate was 70%. Now, one of the things that's changed is the deductions. Back in the 70s, you used to be able to deduct everything. You could deduct interest on your credit cards. Everything was deductible. Under the newest tax laws, hardly anything is deductible, as most of us know. Very, very little can be deductible. They simplified it to really, if you take your average W-2 employee, they can do their taxes on a napkin. It's like, here's my W-2 earnings. take my standard deduction. Here's what my taxable income is. Here's how much I owe in tax. I'm not saying that that's good or bad. I'm just saying that that's what it is. So the tax rates are very low, but there's not a lot of deductions. So what does that mean for the future? And if we were in a little more interactive, I would have asked a few questions here, but I think I probably know the answer when I pose this as to what do we think taxes are going to do in the future? Well, let's take a look. This line right here, this dotted line, that is the US debt. So if my debt was going up like this, you know what I'd have to be looking at doing? One would be reducing debt. We know the government's not going to do that. So what's their other option? Is to raise income or go bankrupt. So how do we raise income? Well, how does the U.S. government raise income? It's through taxes, right? So tax rates eventually will have to go up. And will it be in these next 4 years? We don't know, but eventually they're going to have to go up. And we also have programs that need to generate more tax. Programs such as Social Security. More people are hitting Social Security age. So let me talk real quick about Social Security, even though this isn't necessarily on topic, but I think it's interesting. So currently, Social Security, you pay 6.2% Social Security tax out of your income on the first, and I'll probably be wrong with this number, but it's roughly the first $132,000 that you make. So once you make over $132,000 in a year, you no longer pay that 6.2% Social Security tax. So we all talk about how Social Security is in trouble and it's going to run out of money. Well, there's a real easy answer to this, because there's a lot of people that make over $132,000 income. And if we blew the cap off, that Social Security cap, it could fix the problem. But here, I have a theory on this, and I could be wrong on this theory, but just hear me out on this. So politician walks into the country club, because who do politicians generally hang out with? People with money, right? That's the people that they spend their time and they hang out with. So he walks into the country club. His buddies are all sitting around the table. There's 4 of them that just finished their round. And he walks in and he goes, "Boys, I just fixed Social Security system today." And they're all like, "Really? That's great. How'd you do it?" "Easy. Just took the cap off, and now you've got to pay that 6.2% on every dollar that you earn." Well, he's probably not going to be the most popular guy sitting at the table with the 4 of his rich buddies sitting around the table, right? So I think that it's hindering them. They're not necessarily wanting to come up with this solution because it doesn't make them popular. But it seems like a pretty easy solution to me. You've got to generate more taxes to feed the system. I mean, that's how that system has to work. Okay, this is going to look very rudimentary because I drew it myself. But this is the just a little snippet of the workshop that we give. We give it at Boeing, we give it to other community people, and a lot of people of my clients see it on an individual basis. Basically, these boxes represent different asset classes. So here we've got, or different levels of risk. We've got aggressive, moderate, and safe. And we have a rule of thumb that would say there's a line that represents your age, and you would have that percentage based on your age below the line of more moderate and safe investments. So it's really simple for me. I'm 50 years old. My line would be directly right in the middle. So I would have 50% of my assets in more moderate and safe investments, 50% of my assets in more moderate to aggressive investments. As you get older, this line would move further up. So if you were, say, 70 years old, then you would have 30% of your assets still in more aggressive investments, because we remember those are we're trying to have some growth on those. Matter of fact, these numbers here on the side represent when you're going to use that money. So safe investments would really be your 0 to 5 year money. Well, when it comes to my retirement, I'm 50. I'm not going to retire in the next 5 years, so I don't need anything down here, really. 5 to 10 years would be your more moderate money, and then your 10 plus your money. So again, even if my dad's 82 years old, but he's going to live it to be into his 90s, so we still have a portion of his money up here in more aggressive investments. but we know that those are 10+ year investments. The money that where he's taking money out is coming out of this safe investments, is 0 to 5. The idea would be on a year when the market's up, we take money from the aggressive investments and we move it back down into the safe investments. So we sell high, buy low. I mean, Juanita, real estate, you get this. We want to sell when it's high, we want to buy when it's low, or vice versa. We want to buy low, sell high. So, so that would be how we would split these up. But there's another type of diversification. Here at the top, you see the PT and the AT. The PT would be pre-tax, the AT would be after tax. So this is going back into that conversation about taxes. Let's think about it like a farmer. If you were a farmer and you were given the choice on paying tax on the seed or on the harvest, which would you rather pay tax on? Well, obviously the seed, right? I want to pay tax. So how does that relate to investments? Well, if we think about your typical 401k, it's you put the money in today and you don't pay tax on it, so it saves on today's taxes. But when you pull it out, you're going to pay tax on every penny of it when you pull it out. So there are some options, and the most popular of those being Roth. They also now, a lot of 401ks have Roths in them, and that would be that you pay tax on the money as you put it in. Whatever it grows to in the future, you don't pay tax on. So down here, I got little bags of money. This bag of money is 100% taxable bag of money, and this bag of money is tax-free. So in the end, when we think about our bags of money, I'd rather have a tax-free bag of money than a taxable bag of money. Especially if we go back and think about taxes and what they're going to do in the future. If taxes are the lowest that they've been in our working years right now, wouldn't you rather pay tax on the money as you're putting it in than when they go up in the future? When, let's say it's 15 years from now and you say, okay, now it's time to start taking money out and the minimum tax rate's 30% instead of 12%. Well, I should have been paying tax on my, currently most of us are probably in a 22 to 24% tax bracket. So we could be putting money away, paying the 22 or 24% on it. And when we get to retirement, we could be pulling it out at tax-free no matter what the tax rate is, but probably going to be higher. Unless you're in a super low tax bracket at retirement. But then if that's the case, then this whole conversation is probably mute. So that's kind of my spiel. Does anybody have any questions or want to go back and talk about any of these?
Well, I received my statement in the mail just yesterday, but you and I can talk about that offline.
You want to share?
One of the questions that I've got, when you think about the impacts of COVID, so there's COVID as the pandemic, and then there's the economic decline that we've seen because of COVID and the stress that is on businesses. And maybe part of this question is for Frank as well, because this is something that's been going through my mind. Do you see any long-term impacts of COVID, the pandemic, in the financial markets beyond the shutdown of the economy?
So I'm going to go back to this one because remember we also had swine flu would have been in here too, or not swine flu, but what was the flu of 1919, right?
Spanish flu, right?
Spanish flu, yeah. So that would have been back here before the Great Depression, and it really would have been before the stock market started. But each of these times, yes, there wasn't a pandemic, but there was a major event that was part of this, and I think that we'll get through it. We don't even know how it's going to affect us financially as of yet. I think, under what I do, which is dealing with people's retirement investments, is a little different than the overall economy because the stock market's still doing well. The overall economy is a little bit different story, and probably even the bigger story for the average person is just their own personal finance right now. Their 401k might be, killing it here the last few years, but how are they financially doing? I mean, we know that houses cost more than they've ever cost, right? The price of a car is more than it's ever been. One of the things I talk about, so I have a few of my buddies who are Boeing guys that I Jeep with, and they generally have a big, nice, Dodge Dually that they tow their Jeep with. Well, you compare what they were making back in 08 and 09 to compare to what they're making now, it's not really that much different. But look at the cost of buying that new Dodge Dually today versus what it was in 08 or 09. So yeah, the economy is doing well, but it's really doing well for those people who are using their retirement funds, or the top whatever percent. The average working person is not necessarily feeling the great economy. They're feeling more of the pressure of inflation. So maybe COVID could even help that. I don't know.
Gotcha.
We'll see.
Can I ask Frank a question, not to steal your thunder, Doug?
Go right ahead.
So Frank, one of the things that I'm hearing is how insurance companies are dealing with, businesses going out, the damage that are being caused by riots. Do you see insurance rates going up in the future?
We haven't heard that yet. It's so far actually going towards going down. I mean, it's still been mostly a decrease in claims and that kind of stuff. So right now we're still pushing. Washington's insurance commission's a little slow to respond. So we have several, for Allstate, we have several things that are sitting on the desk right now. The insurance commission at their lower rates right now. So right now it looks like, for the next couple of years, the trend will be to be a little bit less actually. So definitely.
All right. Yeah. All right. Well, thank you for indulging me.
I got a quick question for you, Doug. So in each one of those graphs we saw the stock market like 3 years down and then a big year up. Have we seen that market start to go in that downward direction yet, or is it not doing that? And do you think it will do that?
So no, we haven't really. In March, we did see the market go down, and then it came right back. So do I think it will? Well, that's it would really be me taking off my professional hat and putting more of my just opinion, just like anyone else.
Uh-huh.
I've been thinking it was going to have a downturn in the market for a few years, really, and I'm surprised that it hasn't. So I don't know. I wish I knew what to tell you. So that's where positioning yourself. If we go back to, I'm going to go back to here.
Yeah.
And my camera's in the way of this. Again, positioning yourself to aggressive, moderate, safe based on when you need to use the money. And so this comes into, you've got your own personal risk tolerance. So this line, like I said, I'm 50, and so my line should be in the middle, but that really depends on my own personal risk tolerance. If I'm riskier, then I'm going to have more of my money up here, and so my line would be down further. If I'm less of a risk taker, it'd be up higher. But then it's also, when am I going to use it? And so when we're talking about my retirement money, there's not one penny of it that I plan on using in the next probably even like 15 years. So I'm more risky than what this would say. So again, it's really not worrying about the money that's up here. But if you're planning for college, or you're planning to buy a house, or you got major purchase or whatever, you probably don't want to have those swinging out in the wind, in the S&P, because what if we saw a 30% correction on money that you were planning on sending your 17-year-old to college next year?
Very good. Any other questions for Doug? No? Okay. Well, thank you very much, Doug. We appreciate your time and your expertise and bringing it out to us. We really appreciate it.
Thank you.
Let's give one more round of applause for Doug. Thank you, Doug. Appreciate it. Before you guys go, I want to share with you a little bit of information about an event we're putting together for the holiday season. I know it's almost too soon to be thinking about Christmas, but it's heading our way fast. So the Lake Stevens Chamber of Commerce is putting together a holiday lights and display contest, and we're calling it the Lights of Lake Stevens. There will be a decorating category. There will be 5 decorating categories for residents to enter: traditional Christmas decorations, all one color decorations, a sports themed for like Seahawks, Silvertips, or the Kraken maybe. The best dressed business, we're adding a bit for our members and people, businesses in the area. And the Grinchiest or Charlie Browniest, maybe think of like Charlie Brown's Christmas tree with his one little light, or, or maybe a good comedy entry, something like that. We're putting together the final details, but we wanted to bring it to you now for 2 reasons. One, we wanted to give you time to plan your holiday decoration strategy. And 2, to let you know that we're looking for sponsors for the event, especially for each one of the categories and prize funds. The contest entries will open in mid-November and public judging will be done between December 4th and December 20th online. An awards presentation that we'll broadcast on Facebook Live we'll do on December 22nd or 23rd, still nailing down dates there. The Lights of Lake Stevens will be presented by Ace Hardware, and you can join us and Ace in bringing a bit of holiday cheer to Lake Stevens. So start planning your displays today and reach out to us about sponsorship opportunities.
Okay, I got a question for you.
All right, go ahead.
Is this the greater Lake Stevens for those of us that don't live in Lake Stevens and are chamber members?
We're finalizing the boundaries right now. We're going to kind of stick to Lake Stevens School District boundaries, but we've kind of expanded it in the south quite a bit, especially, and a bit up north, because I know you are out north. So I'll send you the map, and you can tell me how far I need to move it up for you. How's that? That's a good question.
Moving goalposts. Okay.
Yeah, right. Well, no. Once we finalize it, then it's done. And so he has to tell me before I finalize it. Real quickly, again, I want to thank our gold investor, Ace Hardware, Lake Stevens, and Community Transit, as well as our silver investors, Waste Management and Heritage Bank, and Wells Fargo and Republic Services. Just a reminder to check out our events coming up, the Networking After Hours next week on Wednesday, the Morning Mingle the following Tuesday, Chats with Chiefs on October 28th at noon, and then our November Luncheon on the 3rd Wednesday of the month in November 18th. We hope you can join us for one or all of those events. Once again, thank you, Doug, for your time and expertise today. Doug Warren from Larsen Financial. And thank you all for joining us today. Stay safe and take care, everyone.